Good morning. This is Dylan Giovanni with Behind the Markets. Happy Wednesday. Today is Wednesday, July 8th. Today, I'd like to talk about gold and why so many banks on Wall Street think it looks cheap, why they are reiterating their buying recommendations on it. A bunch of new gold prices came out, and I just want to go over them with you. Gold right now is about 4,000 an ounce, 4,175. Goldman Sachs has it at 4,900 by the end of the year. This is revised down from 5,400, but still bullish. They articulated a bullish argument in a note. JP Morgan has it at 6,000 an ounce. They actually see gold pushing higher, and I'll discuss the reasons why. UBS has it at 5,200. These are revised. They think that we see gold higher, is what they say basically. Morgan Stanley has it at 5,200 an ounce. Bank of America has it at 4,800 an ounce. So you have a lot of Wall Street banks raising the price on gold, even though gold has gone down from around 5,000 an ounce here to 4,000 an ounce recently. So it's kind of pulled back. And, it begs the question, what's happening with gold? Look, we talked about this many times here over the years. Lord knows we have. And we're going to continue talking about it because it's a part of a much bigger and more important story. First of all, as a Goldman Sachs note articulates, which is the same thing as we've said 100 times on this channel over the years, is there are structural reasons why gold is going higher, okay? So there have been three big reasons why gold has been going higher. The first is central bank buying. We have foreign central banks reducing or diversifying away from the US dollar. Think of it this way. Use China as an example. China used to take their dollar reserves. They get a surplus from selling us things. Their surplus now is bigger than ever, believe it or not, despite even all the tariffs. Anybody who tells you anything different, that's fake news. Okay, they take all that money. Let's say they're making $50 billion a month. Okay, it's like a $600 billion surplus a year. $50 billion. They used to take that $50 billion and put it into US dollar denominated assets like bonds. That would push interest rates down because you had a big buyer for US Treasury bonds. They've been taking that money consequently and actually pushing it into gold. As long as they have a surplus with us, they're going to keep buying gold. Period. They're not buying the US now. They're selling down their bond holdings. We are, in a global competition with them. I don't think they're going to go down to zero, but they're going down a lot. They've down like 60% of their US bond holdings, which obviously has impacts on interest rates. Other partners and other countries that are friends of ours, not adversaries, they're selling down dollar-denominated assets because of how we've been running the country fiscally in 2016. Trump's first term, then Biden, and then, of course, Trump's second term here. They are spending money like crazy. It's called the debasement trade. Okay, so they know that why would you hold dollars when they're going down just by the inflation, by the printing of massive amounts of money? They're going down a lot every year. They're going down by 3 to 5% a year in value. So people don't want to hold dollars. Anybody with a brain, central bankers with a brain, the way that we've been running the two administrations, the Trump administration and Biden administration, they don't want to hold dollars because dollars just keep going down in value. They want to actually hold on to something that either is a more stable store of value. And of course, we had inflation, which is also a debasement thing. So again, the inflation, the dollar going down is the second reason. And the third reason, just momentum. Momentum, the fast money crowd. They're in and out of things all the time, right? Something's going higher, something goes from 2 to 4,000. Everybody and their mother gets involved. It goes to 5,000, and the minute it turns around, they run away. They want nothing to do with it, People don't really have fixed opinions. They're just momentum investors. So that's what's going on. Those have been the three very, very big drivers of gold, basically. But we might not have the momentum buyers. The air might have just left the momentum trade. The momentum trade went into chip stocks. Obviously, we discussed this yesterday. The SOX now is 20% of the value of the S&P 500, which is a great warning sign. But the basic underlying reasons, the deeper basic underlying reasons driving the structural reasons driving gold higher. They still exist in a very, very big way. Look, six central bank gold reserve survey found that 89%, they interview central bankers, 89% of respondents, 90% of central bankers expect their gold reserves to rise over the next 12 months. What they're saying is, we're buying gold. While a record 45% expect also institutions within that country, non-central bank, are actually going out and going to increase their reserves too. So Goldman Sachs had a note in May basically saying that their 12-month, they see central banks increasing, they're jumping basically to 50 tons per month from 29 tons per month. They actually see it rising to 60 tons of gold buying per month through 2026. So you look, the air has deflated for the momentum gold trade, and it's kind of calmed down a little bit with this hawkish Fed. You have Kevin Worsham here basically saying we're not lowering rates. Doesn't seem likely we're lowering rates. We're keeping them tight. So that disincentivizes some people from actually dumping dollars and buying gold. But you have to ask yourself, first of all, one of the biggest gold buyers have been China. They're going to continue buying it. You have to ask yourself, do you think that this U.S. government will get its fiscal house in order, will get spending in order? Because the only way you incentivize people to hold dollars is for the Trump administration and for whomever follows Trump to actually introduce some fiscal discipline. I personally don't know that's happening anytime soon. This guy is going to add $8 trillion in debt. I mean, that's crazy. His first term was $7.4 trillion. Biden added 10.2, and looks like this term is going to add $8 trillion. If you think that we're going to keep spending more than we take in, and our budget's going to be way out of whack, then, gold looks like a good bet, because certainly the biggest, smartest, most sophisticated money on the planet is betting on that. That's why central bankers, who are the smartest people in the game, they're buying gold for their own countries, because faith in the dollar, very sadly, is eroding at historic rates. Anyway, that's all I have for you today. Have a wonderful day. I'll see you tomorrow.